Yeah, these energy prices are definitely going to mess with inflation. Good morning, everybody. Hopefully you had a good weekend. It's pretty rowdy out there in the world right now. We got a lot of global events messing with the energy markets. And we got a lot of Fed speakers today, which leaves the opportunity for one of them to screw up, say something that they weren't supposed to say, or say something that a reporter takes out of context. That's always a threat when we have speakers speaking. It's one of the reasons that we always want to pay attention to when they are speaking. Not always because they've got something significant to say, but because there is always that threat that they're going to screw it up or that a reporter will screw it up. And it's always something to keep in mind because it's easy to forget that until it happens. And it has happened before and it will happen again. We're mostly down around the world. Hong Kong is basically flat. Japan is up the most with nearly 0.25%, which is, I gotta say, I mean, that's a little bit of a surprise, but we'll take it. Down the most is the Russell, nearly 1%. No small caps. You know, as much as it seems like we never really focus on the Russell, it is an important index and it represents, you know, a broad market space. So probably should give it more attention than I do. But it's down the most. Looking at what is on the docket today with the highest impact probability, Logan is going to speak at 9 a.m. and then Jefferson speaks at around 1 o'clock. But we have central bankers out of England. And then we're going to get data in the overnight on Japan. We got the dollar heading to the upside. We had crude up even more, although it is coming off a little bit. This situation going on right now with the global markets could get worse if one more nation happens to invade any other nation, kick off another war. That's kind of what the markets are looking at. That and contagion. You know, if anybody starts to pile into existing conflicts and exacerbate things. That's a big word on Monday. This is a 5-day view of net options flow. It's something I wanted to point out. On Friday, we actually crossed over back into the green. Now, this is a paid site. Most people aren't going to have access to it. And then, it's kind of a complex tool. It looks intimidating, but really it's not that bad once you just know what you're looking at, right? So the white line is the S&P. The green line is all of the options on the call side. So we call it call premium. And the red is all of the options on the put side, and that's put premium. When more puts are being bought than sold, the red line goes up. When more calls are being bought than sold, the green line goes up. When we've got more calls being traded to the upside than puts, meaning calls are being bought over puts, then the green line will be on top. This thing has its own training and, they've got videos on how to use it and all of that. But one of the things that they use this is for crossovers. So, it's a tradable opportunity when green crosses red. Now you got to be careful of whipsaws and all of that sort of stuff. But on Friday, we had a solid crossover, which was different than this crossover. This one barely lasted an hour and it came back under. And this one, I don't even think it fully crossed over all the way and it came back in again. So not only did we cross on Friday, but the cross held and we went into the close with the calls climbing nearly straight up, even though SPY was pulling back a little bit into the close. So it just showed, until what happened over the weekend, it did show that, you know, the majority of options traders were focused on long calls. That's what this is really kind of presenting there. It's good to hear, right? It's good to hear. It's good to see, good to know that we finally turned a corner. Although now, with everything that's going on, we're going to have to revisit this later today. Depending on the Discord that you're in, you can run a bot command to call this chart up, right? So even though this thing from my service is expensive, if depending on what Discord you're in, you can run the /net flow and net premium commands, and you can get this exact chart on whatever time frame you want. The daily, I've got it set to a 5-day, but yeah, just use the bots in your Discord. Yeah, this is the gap that we have to deal with. This is where we closed on Friday. This is where we opened on Sunday night. Gaps like this are generally closed. We know eventually someday we're going to close this gap. Right now, the question is, are we going to close it early or soon? Or is this a gap that's going to stick around for a while? So we can see, looking at the calendar today, inside of Thinkorswim, there's almost nothing here, right? The bond market is closed, and that's really kind of throwing off all of the data points. Be aware on a short week like this that a lot of times they will move the oil report from Wednesday to Thursday, and we'll get oil and gas on the same day. I don't know if that's going to be the case yet, but that's my baseline bet, is that we're going to have that happen. We also have auctions this week with the 10-year, one of my babies, and then the 30-year this week. So we got some pretty big data points coming out. All right, so here on the right side is a weekly chart, and it's worth kind of looking at these last few weeks with the long tails on the bottom and the recovery back above that orange line. The orange line is the 50-week moving average, and it shows that buying pressure when we get below 4,300, right? How they were able to run it back up again. But if you look at how we closed today and where the concern is, we're still IX10, so we're still sitting inside of this zone, but we had a really nice recovery started. And that's the kind of textbook image that we want to have. Now we've got this gap down. Now, believe it or not, a gap down is not exactly the kiss of death here. A lot of times we'll get a market that gaps down first and then has a really nice rally recovery. So I'm not necessarily all bared up just because we get a gap down, especially a Monday gap down. I got to tell you, on Mondays, I would much rather gap down than gap up, because I've seen too many times where we've gapped up on a Monday and we just spent the rest of the week selling off. So, you know, here's an example where we gapped up and we kept going. There's always an example of each, right? But it's my own bias. I'll own it. I'm not necessarily too upset over this gap down yet. And one of the things that we really want to pay attention to is the half back. So we want to mark out 50%. That's last week's candle, 42.97. We need to close on this week higher than that level right there. The week is still young. Heck, we've barely even gotten started. So, the fact that we're still above it is a good start, and we'll just continue to keep our eye on it. There is a lot of trash to the upside. If we do want to start making moves back up, we got the 20 period and the 10 period moving average weekly to deal with. Bring that out to the daily, and we've got the 200 period moving average, the 50, the 20, the 10, got all of it over our head. Now, interesting enough, we can nearly use Friday's level for the entire week. That it's that close together, but we'll go ahead and mark Friday's level out. 4,300 is what we have for the halfback. Being IX10 is a really nice setup unless your setup candle is a really big wide day like we had on Friday. So no compression expectation play out from this IX10 pattern. And it's not IX10 yet. Anyways, I'm kind of jumping the gun and just assuming that we're going to end up with an IX10. Think about where we closed on Friday and where we're sitting at right now and the gap that needs to be closed. It is going to be the number one focus, right? If we do get through the halfback, then we're going to focus on Friday's open. And then below that, we'll focus on Friday's low. I don't think it's going to get there yet, but it's going to be more event driven than anything else. So looking at the two red lines here, this is the ADR half. The current ADR is 1.3% or about $55 higher and lower from where we opened Sunday night, not from where we closed Friday night. So from where we opened, we could go $55.03 to the upside and or to the downside. If we went the entire move to the downside, it would be this yellow line, 42.60, just round up. And if we went the entire move to the upside, it would put us right against the 20-day moving average, or 43.70. That would also get the gap closed, and we would break out of last week's highest point. So it would be an inside week breakout. We're flirting with that weekly pivot point, which we did bring down. I know there's a lot of lines here, but this is where last week's weekly pivot was at. And we brought it down to this level here. Now we're interacting with it. We want to be above that weekly pivot point if we're going to look for bullish moves in the market, right? So we can wick about dancing above and below it, but at the end of the day, we need to close above that level, just like we did on Friday, if we're going to keep this bullish bias. Volumes are light this morning. They're not extremely light. They're within range. Just would have expected a little bit more than that. Sitting at 115, as long as we're below the average, we're fine. And in fact, as long as we're below 200, we're fine. But we don't want to be below, say, 80. There's no market maker move, so they're not overly concerned this morning. They're not hedging anywhere. Ten-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. We do have the classic D shape right now, and we did make it back through the point of control on Friday, but we gave that move back in the gap down. So we are right at that point of control. 43.11 is the cog line, and we're on it. 43.15 is the point of control. If we happen to get through that, we'll focus on getting this gap closed. With a classic D profile, there's really no edge there at this point, right? So you can see the elevated volumes this morning. But the main takeaway is that we have a VPOC overhead. And that if we are going to focus on an inside day breakout, that 43.45 is going to be a significant level to get through with all of that volume up there. So it's very likely we're going to get a first touch play on that VPOC line and have a real struggle on our hands to get through the close. You can see how much volume we had there. It's where the point of control is as well, right? So it's the most volume from Friday was right there at that close line. So first touch trade strategy is one of my favorites, mostly because it's frequently showing up, right? It's not one of those that maybe shows up 3 times a month, and it's got a high success rate, and the trade is usually done in about 30 to 40 seconds. So I really like first touch plays. I don't see why this one wouldn't be on the table, even if we grind into it rather than spike into it. Speaking of the grind, on Friday, we covered the gap close strategy. Just a nice summary, because I don't get a chance to say this very often. So I like to do it, when I get the chance. We talked about the possibility of getting one of these candles, and I laid out what the trade looks like to run it back up to that point. I talked about how it's probably going to happen before 11 o'clock, because that's how all the others have played out. And that all we needed was that single drive push in one direction, build a little base, run it back up by around 11 or so. Told you. I don't get to say that very often. So come on, let me have it. I'll take it. Hopefully you made some money on it. That's the big thing, right? Yeah, you like it. That's the strategy that we only get like 3 times a month. So as fantastic as it is, we just don't get much of it. All right, so this morning we want to evaluate the volatility. We looked at this on Friday, but it wasn't locked into place on Friday. So we always have to come back in, and look at it on Monday and see, well, how did we close? The new week has a smaller range than the previous week, and this range is built based on volatility. So if volatility was higher this week, the range would be bigger. If volatility is lower this week, then the range will be smaller. This is the weekly expected move drawn out, right? Now they're not hand drawn, so they're not as accurate as they could be, but they do a fantastic job until things start to get really violent, and then you really just got to go draw them by hand. So, consistently, we closed inside the box again last week. So we're starting to get that rhythm again where we're back inside the box consecutively and consistently the way we're supposed to. Remember, we close inside this box 80% of the time in the S&P. If we look at it on other markets, 70% of the time, because the S&P has the most accurate expected move out of all the products out there. So lower volatility. Of course, this range was built before the event that happened over the weekend, the news that came out globally, and it very well changed the range. And if you want to check to see what the new range would be, you always have the opportunity to go in and define your range through the options market, because this is where that range comes from, right? So we can look at, say, Friday's expiration. And this is what we would call a dynamic expected move rather than the static one that I've got marked on my chart. Dynamic range, you keep coming in and you keep reevaluating what's the range now, because the numbers are constantly changing. The static one, the one that we mark every Friday, once we've marked it, it doesn't change. We don't go back in and change it. But if we want to see, has it increased even though we've lost time since Friday, because we've lost time, the range should be smaller. But if the volatility has increased exponentially, the range will actually be bigger even with less time. So right now it's $81 higher or lower. That's about a $162 move from top to bottom. We can just come back out and look at that range. And, we don't have to nerd out on it. We just use the drawing tool. They had 130 for the entire week on Friday. And here it is Monday morning. We've lost a couple days and the current range is 162. So that's how much volatility they pumped into the market over the weekend, about 50 points. So 25 points higher than the top side and 25 points lower than the bottom side. That's what the current expected move is between now and Friday. That's a lot of volatility. That means your options are going to be more expensive. It also means if you try to buy calls and we rally, your calls are going to get volatility stripped or vol crushed like crazy. Nothing wrong with taking a spread just to be able to shunt that decay a little bit or buy deeper in the money, right? That's one way to kind of help offset that a little bit. You could also put on what they call a stupid spread. I know those aren't very popular, but some people don't have, or a lot of traders that day trade are in cash accounts. They're not using an account that can actually do spreads. But a stupid spread would be buying a call at one strike and buying another call at a different strike. So you're not doing a buy and a sell, which is where you need your margin account. The cash account can do stupid spreads. You buy a put and buy another put higher up or lower down on the same series in the same expiration. It's not a calendar, it's not a diagonal, because that would be using a different expiration. This is the same expiration, the same strike, not same strike, but the same expiration. And it's called a stupid spread. If you haven't heard about it, I promise I'm not making it up. It's been around for a long time. It's just not crazy popular. Do both of them in the money, though, just to stay on that theme about volatility crush, because you're going to get your calls volatility crushed either way. If we happen to go up and close this gap, they're going to strip that volatility out hard. The bad thing is if we continue to go down, the puts won't swell in that drop that we would normally get. They won't swell from volatility being pumped in because, well, the volatility is already in there. You're going to be buying those puts with the volatility already in. So that sucks. They're always one step ahead, ain't they? I seen some contract defense names like Raytheon, Lockheed Martin. It's not a surprise to see those names up. Just, as a day trade, sure, you might have an opportunity, but I wouldn't try swinging those things. They're very likely to fall right back out again. Got elevated volume in staples this morning. What's up with that? Whatever. So energy's up, leading the most, well, behind VIX anyways. VIX, and then XLE, and then XOP. XOP is another energy, but it's exploration rather than just energy itself. And keep in mind, XLE is very vague and it's broad, right? Covers a lot of spaces. You want to narrow that down a little bit, like OIH, oil services, or XOP, oil and gas exploration. Gold is up, nat gas. So we got precious metals, got commodities. My benchmark or starting point is 0.5%. So when I look farther down this list and we can see bonds are up a little bit, Bitcoin is up a little bit. They're not up enough to hit my qualifications. And looking at what's down this morning, the XLF financials, airlines, which if you've been keeping track of the news, you'll understand why the airlines are down. Biotechnology, well, scratch that. Biotechnology is not down enough to meet the qualification. So on the downside, it's just finance and airlines. Everything else is kind of negligible. Let's reshape this again. There we go. Bitcoin down 2%. And then the airlines, semiconductors, emerging markets, which is basically China, right? As much as they don't deserve that qualification anymore, they are still in there. You can get emerging markets minus China. There's an ETF for it. I'll have to Google it to find it again, but it's emerging markets ex China. So they took China out of it. That way you can gauge how emerging markets are doing without the influence of China on it. The FANGs are down 1%, finance, then staples, biotech. There's the China constituents through KWeb and tech, communications, on down the list. All right, pot stocks are down the most. There was talk that this pot stock news was going to last farther into the year than it has, but I still don't think it's done. So it was an event-driven news push. A lot of it was just short coverings. So if you're looking to play those pot stocks, check their short covering. Target the ones that still have a lot of shorts in there. Jets were already a dog. It's not a surprise that they're still a dog. And sure, we can point to this news and say that's why Jets were down. But I mean, come on, look. It's not like they haven't already been down, right? They're still just a dog. And with this gap down in the S&P, we're going to see just about 80, maybe more than 80% of the entire market do what the S&P does. So that gap down, we're seeing it reverberated, through all the different sectors, except for the ones that are up on the news. So that's not much of a surprise. The thing to focus on is which ones are likely to continue the move to the downside rather than trying to close that gap. So when we see something like semiconductors down, it's very likely going to try to close the gap, right? Or at least it's going to respond due to its own behavior. It'll throw off this correlation relatively quick. You take something like emerging markets, when we see this still heading to the downside, then we can focus on things like the KWeb constituents, BABA, Baidu, JD, PDD, even though it's in that group, has been doing extremely well. Had that fantastic push on Friday. There was a really high volume levels on PDD Friday too, right? They came in the pre-market above average volume, pre-market volume on PDD, and it was just, what a move, right? So now with PDD, even though its peers are all down and took the gap punch pretty hard. This is still holding up relatively well. I would focus on a half back measure, make sure it doesn't cut below that 50% mark, and then we'd be focused on an inside day breakout. We've got a pretty good setup when you think about it, right? Kind of using OCR analysis on that daily time frame. So this is Friday's close. It's not showing Monday's pre-market action yet here. Let's get to the right market. There we go. That's Friday's close on PDD. We closed at 105.64, and right now the ask anyway is 105.35. So for a setup, this isn't really a bad way to go for a setup. With Friday's close like this off of that high, it kind of gives you a little bit of a line in the sand to focus on. Now, we gapped down because of the news, sure, so we're kind of down here a little bit, but getting back above the close would be your first start. Kind of, you can set an alert there. Then you can early entry while we're still in that zone, or you can wait for it to get the entire inside day breakout. Now, don't get me wrong, this is a crazy place to try to buy because, you know, this big breakout level, but that big breakout level is really close to the 50%, the half back line anyways. And the amount of volumes that were in there was pretty fantastic. And this thing is throwing off the shackles of its peers in its group, right? So it's going completely against the system. Normally, we don't like to focus on things that had that big of a move after that big of a gap up to begin with, but momentum names or momentum plays, you have to buy high, sell higher. You don't, it's not a trend play where you wait for a pullback. So try to approach this with some level of caution, right? Because of the moves that it's already had. But with that level of volume that we had come in there on Friday, it's very likely that this isn't done yet. So then one thing that we can do is just measure this range here and plot that out 50% and 100%, which gives us targets 111 and 118. We do have this area back here to focus on. It's no longer the distal level, but the distal level was 106.38. Since we didn't close above that, an argument could be made that it's still valid as a distal line. I don't know if I want to take that argument, but it can be made. And the proximal line is 104.70. Now we did close above that one, so probably going to argue that that one's no longer valid. The rest of the China ADRs are just the typical beatdown. Then we've got the Bitcoin players down like Riot, Mara. They're looking just like the rest of the market. So nothing stands out with these being down because, I mean, you know, more than 80% of the market is down. pot stocks are down, but really the flows aren't there. Those are just algo pumps, right? It's just little notches. So news put us in our current position. Sentiment put us down here, and sentiment can change really fast, as we saw on Friday. Let's get back into that channel first. The channel would be the midpoint between where we closed Friday and where we opened this morning. Let's get back into that channel as our first line in the sand, then get above Friday's close, and then get above Friday's high, and then work our way up. To the downside, if we happen to flip everything over, then break the Globex low, and then we'll focus on the Globex low before the econ came out from Friday. That'll be the next pivot point. Then below that, the RTH open from Friday, and then the total low of Friday. Those will be the pivots to the downside. You see that move in the dollar, the gap up from the news, and we're just continuing to grind to the upside. We're still around that 106.5 area, so it's not like, we got into new territory above that 107.5, 108. We're not into that kind of territory yet, but we're definitely going in the wrong direction. If we're looking for any kind of tailwind, we're not going to get it with the dollar moving to the upside. If we look at the 10-year, however, it gapped down and it's just holding that gap. So we actually had the 10-year and stocks, quote stocks, just looking at the ES, both take that gap down and both keep that gap right now. Now, you've been in here for a while. If you've seen me talk about this, we reference the 10-year a lot. With that rising 10-year, we have the expectation of the S&P going in the other direction, right? That's the way it's been for a while. So look, this is one of those weeks where I'm telling you the correlations and the inverse correlations that we normally use are not there. So don't be looking at the 10-year moving up or down for any kind of play or any sort of bias build for the ES. They both look exactly the same this morning. Gap down and holding the range. Correlations and inverse correlations are all well and great and good and fun until they don't work. And one of our jobs is always to recognize if we're becoming uncoupled, right? Or decoupled. So bonds gapped up as we would expect after looking at the yields, just an inverse there. We're looking for them to close the gap, just like we're looking for all these others to close the gap. And US dollar Japan is down like the 10-year. Very similar chart. Gap down, holding the range. We got those equal lows and lower highs. We're forming a wedge here. It's cleaner than the others. Definitely worth keeping your eye on US dollar Japan today. And if you look at US dollar China, we did come down into that quarterly level. It's a significant line in the sand. It's very unlikely that we're going to close below that today. I mean, we could, but it's going to take more of a push to get us down there. So this is where a lot of the market angst is at today, right? These things need to get back into their normal rhythm. And until they do, trying to trade into the equity markets or even into the futures like we normally would do, I would say approach with caution. These things need to get back into their regular rhythm. That's what I got for you guys. Be careful. Have a good week. I'll see you all tomorrow.